So on this edition, we're going to be discussing mutual funds versus solo stocks here on Investing for Beginners. Now, obviously, I would heavily implore you to check out the other videos in this series because I'm building these videos one behind the other, so to speak. And if you don't know the basics and if you don't know what I've talked about before, some of this stuff may confuse you. So check out the playlist on the channel in the Speakdom folder and make sure you listen to the previous videos to get more insight about how to invest, what to know before you invest, and things of that nature. So, again, this is called solo versus mutual funds. So I think before a lot of us got in this game, before we chose to invest our money, we would always see and hear these stories about, buy low, sell high, and buy this stock and buy that stock. And there's so many different companies that are tradable. There are so many public companies. There's so many different things to invest in, treasuries, real estate investment trusts. There are mutual funds, of course, ETF funds, and also commodities. And if you're getting into stocks, I think, well, even before then, I think a big reason as to why people don't want to get in is because of how overwhelming it is. Because there's so many companies, so many ways to put your money. Where do I put my money? Who do I trust? Where can I go? Right? And I think that led to a lot of confusion for a lot of people. Because, you don't know. And then what happens is that when you don't know, when you look at the market and you see these graphs and these charts and these numbers and these stock tickers and you don't know where to put your money, you can be kind of confused. You can be like, well, where the hell do I put my money? What do I do? And you've got people who are giving you advice from different directions, people who either know what they're talking about or they don't know. And sometimes it can be very hard to decipher what is and isn't true. And then sometimes you don't have time to research, so you usually just give up. I've seen people just, they're about to invest, then they just get freaked out. And they don't do it. They want to spend their money on something that is only going to rot their teeth in their brain. Like what Kevin McAllister said in Home Alone 2, Lost in New York. Tremendous movie. Luckily, there are things that make our lives easier, and that is where mutual funds and ETF funds come in. So you could go in and make an account with Robinhood or M1 Finance or whoever, Webull, whatever you want, and go in and buy stocks for Apple and Tesla and Microsoft and Amazon and Google all day. You could do that. People do it all the time. And a lot of these companies that are big blue chip companies are safe bets. But what if they go down? Can you really handle a low period? Can your anxiety deal with it? What if you want to invest in more companies but you don't have the money to? Because a lot of these companies do have a minimum. So that's where mutual funds and ETFs come in. I think that when it comes to new investors, people who are new at this, and even veterans, but one thing you'll find is that a lot of people who are wise with their investments, no matter how long they've been doing it, I've been doing it for over 5 years. I have friends who have been doing it for 10 years, some 8, some 15. They all have a mix. They all have a portfolio that's very diversified. And when I say diversified, I don't just mean different stocks in different industries, even though that's certainly the case. But I literally mean like you have a mix of solo stocks, mutual funds, and ETFs. People who have a lot of money in the market usually have a mix, but you don't have to have a mix. I think for beginners, going down the route of ETFs and mutual funds is probably the safest bet and probably the most economically sound because you've got an ETF fund, an exchange trade fund, which takes multiple stocks in the stock market from a particular sector, from the S&P or whatever that mutual fund, or that ETF fund, is pulling from, whatever index they're pulling from. They're called index funds. And it's several different companies. It could be anywhere from 15 to 500 or more. And, you put in like $1,000, and that $1,000 gets divided into however many companies it is. So if there's 1,000 companies, $1,000. $1,000, $1 per company. If it's 500 companies, it's $2. And it's a very safe bet when you do that because if one company should go down and but the other ones go up, you're not going to lose any money. You'll probably get money. And whether you go with the ETF or a mutual fund and the history of those funds will determine your success. Because if you have a good growth stock mutual fund, a long-term mutual fund, and there are some mutual funds that have been around for years. In fact, some have been around decades, literally, and have performed well. If you find a good one that's performed well with a good fund manager, you don't have to worry about anything. You just put the money in, and he'll take care of everything. You pay your expense ratio, it's taken out of your earnings once a year. It's like 0.00 something percent. It's usually not a lot. And this person will manage your money for you. Now, this is not a financial advisor. This is a fund manager. He manages the mutual fund. He doesn't just manage your money. He manages all the money. So you and the 10,000 other people that invested in that fund, he takes care of that fund, what goes in and what goes out. And you've got some fund managers that are really, really successful, have been around forever, and they know what to do. They have these instincts where they know what to do, and they usually can see trends, and they do all the hard work for you at a very, very, very low cost to you, which is why I advise people to go with mutual funds as opposed to going with financial planners. Now, if you've got a bunch of money, if you've got tons of money, and you feel like it's safe to at least get some kind of financial advisor, whether it be one of the Dave Ramsey SmartVestor Pros or any of the ones out there, and you want to at least listen to them, there's nothing wrong with that. But please be really careful with these financial advisors, because a lot of them sometimes try to sell you products that are going to benefit them, and they're going to get commissions off of it. Or they work for a company. Like if you go with, for example, a financial advisor who works for, Raymond James Financial, right? He's going to try and sell you Raymond James stuff. He might not have your best interest. Again, everyone's different. So you want to make sure you go with somebody, as Dave Ramsey would say, who's a teacher, who can teach you things. And not so much just take your money and put it in somewhere, but somebody who can teach you how things work. But that's if you're going with a financial planner. That's not what this video is about. This video is about mutual funds versus solo stocks. I do not believe that investing in penny stocks is a good idea. It's never worked out for me, and I honestly have only met one person in my whole life who it's actually worked out for, that I know in real life, not over the internet. People online can say whatever they want, right? We're talking about actual success stories. Penny stock investing is sort of like investing, doing the day trading thing. High stress, not for everyone, very time consuming. Whereas when you go with mutual funds, I think that the least time consuming method, and the one that's the safest, is to take your money, invest in a growth stock mutual fund or an ETF fund. When you first start out, pick a good one and just leave it in there. Then as you start earning more money, you can add more money to that fund until you max out your Roth IRA contributions, and then you go with your non-taxable accounts, later on. Or you can later on invest in another mutual fund or another ETF fund. You don't have to put all your money in one fund. You can put a little bit here, a little bit there. If you want one ETF for energy, one for industrial, one for tech, you can do that. You have lots of options. That's the thing about investing, is it's like when you have the money, it's like going to the grocery store. Except there's probably even more options, and I'm not even kidding when I tell you that. There are hundreds upon thousands of mutual funds and ETFs, which is why I say it can be overwhelming. So I would say start with something you know is going to work, something you're confident in, whether it be tech or construction, whatever. Pick a good mutual fund. Look at the history of the fund, see how it's grown, and decide from there. And then once you kind of have time in the market, when you have more experience and more time, because you have to understand your money will snowball, but so will your knowledge, right? The more time you do this, if you don't have time to dive in now, you can always put a little bit in, because you don't want to wait too long, and then kind of slowly build up your investing intellect and learn more about how these things work. And then as you get more money, you can experiment. I have both. I started with mutual funds, right? Then I got into solo stocks. And I started with mutual funds, learning how the market works, seeing what goes up, what goes down. And I said, okay, let me try putting more in individual stocks like your Teslas and your Amazons and whatnot, and seeing how they do. It's just more of more focused. But for new people, I would say to start with a mutual fund. And remember, an ETF fund. And remember, when you buy a mutual fund, if you see how it grows, let's say you buy a mutual fund, right? Let's say you buy one, you put money into one, right? And you notice growth within the first 6 months. And the mutual fund will actually tell you what companies are in it. So let's say you put money in and you notice growth and you see companies in the fund. You know, whether it be Visa, MasterCard, whatever. I'm just naming companies for the sake of naming companies. And you say, okay, these companies have worked out well for me. Let me put in some money in the individual stock for these companies. You can do that. You could actually do a thing where you look at mutual funds, and instead of buying the mutual fund, you instead look at the top 10 companies and just go invest in them individually. You can do that as well. However, when you do that, you're not going to have a fund manager there. And there's also other companies within that fund that you might not be able to see upon just the top 10. You have a lot of options, but I personally feel like for new people, go with growth stock mutual funds. You can try dividend mutual funds if you want, but I would go with the growth ones first. See how your capital gains go up, and then from there, you know, if you feel more comfortable, maybe then try going into solo stocks. But remember, not penny stocks, individual stocks. But remember, go with companies that are proven, that have proven track records of success for the safest bet. If you want to go a little bit riskier, you can do that as well. But it's all depending on what you want to do with your money. There is risk versus reward, and whenever you sign up for one of these brokerage firms and you go mutual fund shopping, you can actually see, like, you know, it'll usually give you a chart of like risk versus reward, like less risk, less reward, more risk, more reward. And you'll want to kind of diversify it there too. Okay, do I want to put a little bit of money in the high risk one and more money in the low risk one? Or maybe you want to try putting in more money in the high risk one. You know, it's up to you. I mean, there's a lot of options. I'm just kind of giving you the different options there are for you and giving you what I think you should do as far as for people starting out. And I think mutual funds and ETF funds is the way to go. Vanguard, Fidelity, there's so many companies out there. I would go with one of those two because they have low expense ratios and just kind of slowly keep going from there. It's funny because when I was younger, I want to say about 13, 14 years ago, I used to listen to the radio, believe it or not. Who does that anymore? I used to listen to the radio every morning. And every afternoon there was a show that would come on called the Mutual Fund Show. And I never really listened to it. Or, I mean, I did for a few minutes, but I'll usually change it because I didn't really care. But man, was I dumb. Because I could have learned so much from the Mutual Fund Show. I could have learned so much about mutual funds and what they were doing and what was working. It was all about mutual fund investing and shopping. I could have learned so much, even whether it be good advice or bad advice, and I chose not to do it, and I should have done it. But what can you do? You know, what can you do? You know, you look back when you're young and you make mistakes, but it's never too late until you are gone. So remember that. Always do your research. Thanks for listening. Have a great day, and good luck.